Welcome to your weekly market update. We are seeing wage pressure inflation start to come down. That means the rate that wages are increasing, that's what you're paid in your job. That pace has started to slow down. What's also slowing down is job poaching. That means other jobs coming, recruiting, pulling them away from that job, paying them more to come over to this job. You're seeing longer periods than this time of next year of people staying at their job. So that's called wage pressure inflation. That is one of what I would call the three key components to mortgage rates and just the cost of everything to stop growing at such a pace. Will we see deflation? I don't think so. I don't think we'll see prices go backwards. Maybe I'm wrong. I think we'll have to go into a pretty deep recession in order to do that. And I don't think this is a deep recession. I think we're right on the borderline of what a recession looks like. It's about 4.6 to 4.7 on the unemployment. That will come out on Friday. We're at about 4% right now. So not terrible on the jobs market. What the BLS, which is the Bureau of Labor Statistics, why the report is so flawed, is it counts every job creation. So if someone's working 3 jobs, and I obviously do mortgage applications and see a ton of loan apps, I've never seen so many people working 2 to 3 jobs, just more than I've ever seen. And it makes the economy look good because the number looks good. But the truth is that people are having to work 70, 80 hours a week just to get by to pay their expenses. I've seen a lot of that more so ever than in my 23-year career. So that report is a little flawed. You're starting to see ADP be one of the reports that the markets also look to. So as we go into this jobs report on Friday, we are optimistic that unemployment is going to go up a little bit, and that the 180,000, I believe, job creation that is expected won't come in at that number. But the data is always manipulated by these second, third jobs and what's called a birth-death ratio that's been manipulated and changed more so ever than in history. So time will tell. These are the things that we're going to need in order for interest rates to come down. Interest rates have been stable. It's probably been the most stable time of the year. From about February to March was pretty stable too. But besides that, it's been super volatile. So we're still seeing 20-year fixed loans in the higher 5% to low 6s. We've locked several in with larger down payments, good credit scores, single family homes, that 25 to 30% down payment. We've locked some in at 5.875, 5.99. We have had of our 17 closings this month, 14 of them got a better interest rate than where we started. And how do we do that? We look at bond trading. I trade stocks, I trade bonds. And if you can see the screen of the bond chart, don't know why that's not pulling. Let me try it one more time here. There we go. So if we see interest rates, everybody that locked here, obviously, if you look over, this is myself locking in all of our loans at this point. You can see all those people got the best interest rates that the market has seen since here, April 5th. So a lot of lenders were locking in here because they were panicked. We continued to float after this lock, and this was the 0.5% increase most of our clients that closed in June with us received. So instead of getting 7, 7 and 8, they're getting 6.5. These are with 20, 25% down payment, 780 credit scores. Remember that your down payment and your credit score impact your interest rate. So we saw a little bit of a scare here last Friday. Monday was a bad day too. And then Tuesday and today we're seeing some recovery. So we will want to see how this works out. Friday is a big report. We have some strong stability here. So we're continuing to advise our clients to float. when you work with us, I just take all that over. I promise you're going to get this rate or better, and I watch all this for you. If I miss the market, if I do something where the rate went up and I didn't lock you, I pay the difference to get you the rate that I promised. So that is how we operate, and we have a free float down. It's not truly free though. Lenders will tell you that it is. No cost is provided to you, no cost is passed along to you. But let's say rates went down to 6%. If you were to lock and your lender didn't have this knowledge and understanding of how interest rates and mortgage bonds and the markets impacted that rate, and they just lock you in, and then they do the float down, let's say it went down to 6%, they're giving you 6.25, not the 6% is that. I would rather float you and then lock in here and give you the 6% instead of giving you 6.25. So that's what my knowledge, my team that's trained to do this, that's what they bring to your home search, to your rate lock, and to following up with opportunities for you to refinance in the future. So happy birthday, America. Have a great 4th of July. We will be off tomorrow. We will have coverage Friday and our typical weekend coverage because we're putting a ton of deals together on the weekend. Don't forget about our $5,000 pre-approval guarantee, our 10 to 15 day close on time guarantee, our appraisal gap coverage insurance strategy, as well as our good as cash plus program. And we also have a bridge loan if you don't want to have a home sale contingency that will buy your home after 4 months on the market. So we have every solution for you to go out and buy the new home. We have the winning strategy that are helping our realtor partners, our clients win in a multiple offer situation that other loan officers just frankly don't know how to use or don't understand or don't have. We got it. We will help you win in a multiple offer. Have a great 4th of July. Have a great time with your family, and thank you for your trust so far, making 2024 a great first half of our year.